Ladies and gentlemen, let me begin with a simple but unsettling question. Who really controls the global economy, the governments we elect, or the financial institutions we never voted for? When Bank of America makes a 65 silver call, and when China suddenly cuts exports, we are told these are technical decisions, market signals, nothing to worry about. But history teaches us something very different. These are not isolated events. They are symptoms of a deeper structural problem in global capitalism, one that we ignore at our own peril. Now, Bank of America's 65 silver call is not just a bold prediction, it is a confession. It tells us that powerful financial actors expect serious instability ahead, currency pressures, inflationary shocks, and declining trust in paper money. Silver, like gold, becomes attractive when people fear the system itself. This is not about jewelry or industrial demand alone. This is about a financial elite quietly hedging against a crisis they know is coming, while ordinary people are left exposed to rising prices and stagnant wages. At the same time, China's decision to cut exports must be understood not as aggression, but as self-defense. For decades, China has been the factory of the world, supplying cheap goods that kept inflation low in Western economies. But that model came at a cost: environmental damage, labor pressure, and strategic vulnerability. By cutting exports, China is signaling that it will no longer sacrifice its long-term stability to sustain short-term profits for multinational corporations headquartered in the United States and Europe. Here is the connection the mainstream media refuses to make. When China restricts exports, supply chains tighten. When supply chains tighten, prices rise. And when prices rise, financial institutions rush toward hard assets like silver. The Bank of America call, then, is not prophetic, it is reactive. It reflects a system scrambling to protect itself while passing the burden downward to workers, consumers, and taxpayers. And let us be clear, this is not a failure of China, nor a clever success of Bank of America. This is a failure of an economic system that prioritizes profit over planning, speculation over stability, and private gain over public good. Capitalism, in its current form, thrives on crisis. Each disruption becomes an opportunity, not to solve problems, but to monetize them. When a major financial institution like Bank of America publicly advances a 65 silver call, it is not expressing optimism about economic growth or productive investment. It is revealing anxiety about the stability of the system itself. Large banks do not make such calls casually. They operate with privileged access to data, capital flows, and global risk indicators that are invisible to the public. When they turn towards silver, a traditional store of value, they are quietly acknowledging that they expect turbulence, currency instability, inflationary pressures, and heightened geopolitical risk to define the economic landscape ahead. The hook here is simple but unsettling. If those who profit most from the system are preparing for disruption, what do they know that the rest of society is not being told? Silver, in this context, is not a bet on innovation or productivity. It produces nothing, employs few, and adds no new capacity to the economy. Its value rises when trust falls, trust in central banks, in fiscal discipline, and in the promise that paper money will retain purchasing power. The 65 silver projection signals concern that monetary authorities may be forced to choose between inflation and financial collapse, a choice that history shows almost always disadvantages working populations. Banks hedge against this outcome by shifting into assets that preserve wealth, while households face rising living costs with no comparable protection. What makes this moment especially revealing is the timing. Wage growth across much of the global economy remains sluggish, productivity gains are uneven, and debt levels, public and private, are historically high. In such an environment, a genuine growth narrative would emphasize investment in infrastructure, technology, and human capital. Instead, we see a rush toward defensive assets. This contrast exposes a fundamental contradiction. Financial markets may appear calm on the surface, yet the institutions that dominate them are positioning for breakdown rather than expansion. There is another layer often ignored. When banks prepare for crisis, they do not warn society, they reposition their portfolios. Risk is not eliminated, it is redistributed. Inflation erodes real wages, asset prices become more volatile, and economic insecurity deepens for those without access to hedging instruments. The silver call, therefore, functions less as a forecast and more as a signal of asymmetric power. Those at the top can anticipate and insure themselves against instability, while the majority are left to absorb its consequences. That is the real economic meaning behind a 65 silver call, When silver begins to attract serious attention from major financial institutions, it is rarely because of its use in electronics or solar panels. It is because fear has entered the system. Silver has long functioned as a financial refuge, a place where capital hides when confidence in monetary stability weakens. The renewed interest in silver as a hedge against systemic risk reveals a deeper concern about the durability of the economic order itself. The hook is unmistakable. Markets may speak the language of growth, but money is quietly preparing for survival. Unlike equities or bonds, silver is not dependent on corporate earnings or government credibility. Its appeal rises precisely when those foundations begin to crack. Persistent inflation, expanding fiscal deficits, aggressive monetary easing, and rising geopolitical tensions all erode faith in traditional financial instruments. In such conditions, silver becomes attractive not because it promises high returns, but because it promises endurance. This shift signals that powerful investors are less focused on maximizing profit and more concerned with preserving wealth in an environment they perceive as increasingly fragile. What makes silver particularly revealing is its dual character. It is both an industrial commodity and a monetary asset. When financial actors emphasize its monetary role, they are effectively downgrading confidence in currencies and policy institutions. Central banks assure the public that inflation is manageable and temporary, yet capital flows suggest skepticism. Silver prices respond not to speeches, but to actions, excessive money creation, rising debt burdens, and the political constraints that prevent meaningful structural reform. The result is a quiet vote of no confidence in economic governance. This hedging behavior also exposes inequality embedded within the financial system. Access to silver as a protective asset is not evenly distributed. Institutional investors and wealthy individuals can allocate capital into precious metals with ease, while most households remain tied to wages and savings accounts that lose value during inflationary periods. Risk, therefore, is not shared, it is transferred downward. Silver protects those who already possess capital, while rising prices punish those who depend on income rather than assets. The deeper implication is that systemic risk has become normalized. Instead of addressing the root causes, over-leveraged markets, speculative finance, and fragile supply chains, the system adapts by creating escape routes for capital. Silver becomes one such exit. It does not solve instability. It merely allows those with foresight and resources to shield themselves from it. When silver shines brightest, it is not a sign of economic health, but a reflection of collective doubt about the future of the system itself. When China cuts exports, the dominant narrative in Western economics frames it as a threat, a shock, or even an act of economic hostility. That framing misses the deeper reality. China's export reduction is better understood as a strategic recalibration, driven not by confrontation, but by necessity. For decades, China functioned as the backbone of global manufacturing, absorbing environmental damage, labor pressure, and thin profit margins to sustain consumption elsewhere. The hook worth confronting is this: no economy can indefinitely subsidize global stability at the expense of its own long-term resilience. Export-led growth once served China well, but its limits have become increasingly clear. Rising domestic wages, demographic shifts, and mounting environmental costs have eroded the advantages of low-cost mass production. Continuing to flood global markets with cheap goods would lock China into a development path that prioritizes volume over value and short-term output over long-term security. By tightening exports, China is signaling a pivot toward internal economic balance, greater emphasis on domestic consumption, technological upgrading, and strategic industries critical to national stability. There is also a crucial geopolitical dimension often ignored. Dependence on external markets creates vulnerability. Trade wars, sanctions, and supply chain disruptions have demonstrated how quickly access to global demand can be weaponized. Reducing export exposure is therefore an act of risk management. It allows China to retain greater control over key resources and production capacities, particularly in sectors essential to future economic and technological leadership. What appears to some as contraction is, in strategic terms, consolidation. This shift challenges the global economic order, built on the assumption of endless Chinese supply. Advanced economies grew accustomed to low inflation and high consumption precisely because Chinese exports kept prices down. As China rebalances, that hidden subsidy disappears. The adjustment costs are now being felt elsewhere, revealing how dependent global price stability was on one country's willingness to prioritize external demand over domestic welfare. Perhaps most revealing is what this move says about economic sovereignty. China's export cuts reflect a refusal to remain trapped in a role defined by multinational corporations and foreign consumer markets. It is an assertion that development must serve national priorities rather than global profit chains. In that sense, the decision exposes a broader truth about the world economy. When nations begin to plan for themselves instead of the market, the fragility of the existing system becomes impossible to ignore. When a major exporter tightens supply, the effects do not remain confined to ports and factories. They travel directly into prices, wages, and everyday life. Global supply chains are built on the assumption of constant flow, minimal disruption, and maximum efficiency. The moment that flow slows, the system reveals how fragile it truly is. The hook is immediate, and personal inflation does not begin at the checkout counter. It begins when goods stop moving as freely as markets once assumed they would. China's reduction in exports amplifies this fragility. As a central node in global manufacturing, even small adjustments in its output ripple across multiple industries simultaneously. Intermediate goods become scarce, production schedules are delayed, and firms face higher input costs. These costs are rarely absorbed by corporations for long. They are passed along to consumers in the form of higher prices, creating what economists describe as cost-push inflation. Unlike demand-driven inflation, which can be cooled by monetary tightening, supply-driven inflation is stubborn, politically volatile, and socially regressive. What makes this inflationary pressure particularly damaging is its uneven impact. Households spend a larger share of their income on essentials, food, energy, transportation, precisely the sectors most sensitive to supply disruptions. When supply chains tighten, prices in these categories rise fastest. Wages, however, adjust slowly if at all. The result is a silent redistribution of wealth away from workers toward firms and asset holders who can reprice goods or protect capital through financial instruments. Inflation becomes not just an economic phenomenon, but a mechanism of inequality. Policymakers often respond with familiar tools, higher interest rates, fiscal restraint, appeals to patience. Yet these measures do little to resolve the underlying problem. Tightening monetary policy may suppress demand, but it cannot manufacture semiconductors, ship raw materials, or repair fractured logistics networks. Instead, it risks slowing growth and increasing unemployment while prices remain elevated. The public is told that inflation is temporary, even as its structural causes persist. The deeper issue is that global supply chains were optimized for profit, not resilience. Just-in-time production, geographic concentration, and relentless cost cutting created impressive efficiency under stable conditions, but little capacity to absorb shocks. When exports are cut and supplies tighten, the system has no buffer. Inflation, then, is not an accident or an external shock. It is the predictable outcome of an economic model that sacrificed stability for short-term gains. What we are witnessing is not a sudden breakdown, but the long-delayed bill for a fragile global production system. One of the most revealing features of modern economic crises is not that they occur, but that they are profitable for a select few. Volatility, uncertainty, and disruption are often portrayed as collective misfortunes, yet within the financial system they function as opportunities. The hook that demands attention is this: when the economy falters, it is not everyone who loses. Some are positioned to gain precisely because others cannot escape the damage. Financial elites possess tools that transform instability into advantage. Through access to advanced information, complex derivatives, hard assets, and global capital mobility, they are able to anticipate shocks and reposition before the consequences reach the broader population. Inflation, for example, erodes purchasing power for wage earners, but it inflates asset values for those holding real estate, commodities, and financial instruments indexed to rising prices. What appears as economic pain from below is often a revaluation of wealth from above. This asymmetry is not accidental. It is built into the structure of the system. Corporations respond to supply disruptions and rising costs by increasing prices, cutting labor costs, or both. Workers face stagnant wages, reduced job security, and higher living expenses simultaneously. Governments, constrained by political pressure and fiscal limits, often step in not to protect households directly, but to stabilize financial markets. Bailouts, liquidity injections, and emergency lending facilities preserve institutions deemed too big to fail, while individuals are told to adjust, economize, and endure. The language of inevitability plays a crucial role here. Crises are described as natural, external, or unforeseeable. obscuring the decisions that made them profitable for some and devastating for others. When inflation spikes or supply chains fracture, responsibility is diffused, yet the outcomes are sharply concentrated. Those with capital can hedge, diversify, and wait. Those without it must spend more of their income on necessities, often taking on debt simply to maintain basic living standards. What is most striking is how quickly crisis profits are normalized. Once markets stabilize, the gains captured by financial actors remain private, while the social costs, higher debt, weakened public services, and long-term inequality are socialized. This pattern reveals a fundamental imbalance of power. Economic disruptions do not merely expose inequality, they actively reproduce it. The system does not malfunction during crisis, it operates as designed, channeling risk downward and reward upward, leaving the public to absorb the costs of instability they did not create. When these developments are viewed together, financial institutions retreating into hard assets, supply chains tightening, and nations reasserting control over production, they expose not a series of isolated shocks, but the structural limits of contemporary capitalism. The hook worth confronting is this: the system is not breaking because it is being challenged, it is breaking because it is doing exactly what it was designed to do: prioritize profit over stability and private accumulation over collective well-being. Modern capitalism relies on perpetual expansion, yet it operates within economic, social, and ecological constraints that make endless growth impossible. To maintain profitability, firms externalize costs onto workers through wage suppression, onto governments through debt, and onto the environment through degradation. For a time, globalization masked these contradictions by spreading production across borders and lowering costs. But that strategy also increased fragility. When any major node in the system adjusts its priorities, the entire structure shudders. Speculation has increasingly replaced productive investment as the engine of accumulation. Capital flows more readily into financial assets, commodities, and short-term trades than into long-term projects that create stable employment and social value. This shift does not reflect efficiency. It reflects risk avoidance by those with the most to lose. When banks bet on silver instead of factories, they are signaling doubt in the system's capacity to deliver sustainable growth. That doubt is rational, given rising debt levels, political polarization, and weakening public institutions. The promise that markets will self-correct has also lost credibility. Repeated interventions, bailouts, emergency lending, and monetary expansion have become permanent features rather than temporary responses. These measures prevent collapse, but they do not resolve underlying imbalances. Instead, they inflate asset prices and deepen inequality, creating an economy that appears stable from above while becoming increasingly precarious from below. What ultimately emerges is a contradiction at the heart of the system. Economic decisions that are rational for individual firms and investors collectively produce instability. Each actor protects itself, but no one protects the system as a whole. Planning is rejected as interference, even as markets require constant rescue to survive. This reveals the core limitation of contemporary capitalism. It lacks mechanisms to democratically coordinate production, distribution, and investment in the public interest. The result is an economy that generates immense wealth, yet repeatedly fails to deliver security, equity, or resilience for the majority. So the real question we must ask is not whether silver will hit 65 or whether China will export more or less next year. The real question is this: why do we live in an economy where a handful of banks can prepare for crisis while the majority are forced to endure it? Until we democratize economic decision-making, until workers and communities have real power over production, trade, and investment, we will keep witnessing these so-called surprises. And remember this: when banks start betting on silver, and when nations start pulling back from global markets, they are not warning us about the future. They are revealing the truth about the present. Thank you.